a 3% interest rate is seductive. I mean, let's face it.
Hello and welcome to Change in the Market, your mindful guide to the ever-changing real estate world. Today, I am your new host for this week, Kevin Chamala, here at Masiello HQ, and joining me is Chris Masiello, CEO, author, and real estate expert. How are we doing today, Chris?
Kevin, good to be with you. It's our first time doing this.
I know, it's exciting, right? New faces.
Yeah.
Always an exciting topic.
Yeah, it's exciting. I think we should, with Peyton being on vacation, I think we should have a ratings challenge to see who stays to be the host, either you or Kevin, based on the ratings we got.
I love it. We'll let the viewers decide. We'll like it, comment. We'll see which host wins the host battle for Change the Market episodes. I love it, Chris.
Hey, we gotta poke fun at Peyton, every chance we got, right?
Absolutely. So I think today what we're going to do is kind of bring all together the last 4 episodes of what we discussed, right? Inflation, interest rates, what that means for consumers today, what that means for the housing market, and how we expect it to change in the future or the near future over the next 12 to 18 months.
Yeah. So, I think pulling together the last 4 or 5 episodes, last really 4 or 5 weeks, and how do we kind of filter the economic data that's really rapidly, coming forward. And I think if we can understand things that things can start, like changes can start as nuances, then they become trends, and then they just become a fact. And I think that's kind of where we've been. You can say that over the last year, but certainly over the last, few months where, we've gone from interest rates going up, the nuances of that, what's the trend? And now here's the facts. This is the environment we have. So I think we're at an inflection point when it comes to inflation. I think we're over the hump on inflation now. It was at 3% in June. The target rate for inflation for the Federal Reserve is 2%. No one sees them getting there with that. Personal opinion, I think it's kind of ridiculous. But nevertheless, though, that's what we have. But I think we're over the hump with that. And so we're kind of, as we were in an environment with ascending interest rates and high inflation now has subsided. Interest rates are still kind of up there, but I think we're now we're in the curve where we're really leaning into the second phase of the story of interest rates, which, okay, when do they start to go down? And there is, again, nuance to trend to fact. Is that it's becoming very common, really, financial advice that people are getting, which I would concur with, is that you really want to be leaning into the market now, whether you're a buyer or a seller. I don't think it really matters. You want to be leaning into the market now because you're going to be leaning into a market that has slower appreciation rates, not lower, not negative appreciation, but slower appreciation rates. But you want to be leaning into that market today because, one, if you're a buyer, you have less competition. That's the first thing. And then you can always refinance your rate later. And then the same thing goes if you're a seller. You put your house on the market. There's still an extreme shortage of inventory, so you're still in a good position. And then as a seller, you would typically become a buyer, and then you're getting the same benefit. Less competition. It doesn't mean that less competition means you're going to be able to get, a fire sale on price. But what it does mean is that you have a little more time. You're not under as much pressure. Where we're still seeing multiple offers, but we're seeing less of it, and so you're able really to get into the market with a lot less stress and a lot less pressure. With hearing the footsteps of people behind you, other buyers that are interested. Not to say that won't happen, but you probably will have less of it. And I think now we've really come into the phase where this is what we have.
And what would you say to those buyers or sellers that would say, I'm in a 3% interest rate now. If I sell and buy a new house, they'll lock me in at, I think, 7% today, right? What about the people that are so interest rate heavy focused when it comes to determining their housing market opportunities, right?
Well, a 3% interest rate is seductive. I mean, let's face it. And like 90%, and we talked about this a couple of weeks ago, 90% of all mortgages are, I think, below 4% or somewhere in that number. However, you can't stop living because of interest rates. So if you need the extra bedroom, or you're at a point where you want more room, whatever the case may be, you're bored. You want a new house, you want a new project, right? Whatever the case may be, you can't stop living for that. I had this circumstance where I had somebody ask me, and I was in a non-work environment, and I was actually at the doctor's office for a checkup, and the nurse was asking me, if she knew who I was, and she said, well, my husband and I are thinking about selling our house. When should we sell it? And I'm like, well, whenever you're ready.
Right.
And she's like, oh, good point. I said, yeah, don't worry about the rest of it. If you're emotionally ready, you're financially ready. Ready means ready. And so I think that's kind of the environment we're in. But we've talked about this, I believe, last week. Timing markets is a notoriously dangerous game because you can't outsmart a market, right? You can lean into it, but you can't outsmart it because it has its own algorithms. It does its own thing. And it has tendrils to it that are very hard to see. And I think, for the sake, again, do the math, right? If you have a $400,000 house and it appreciates at 10% a year, that's $40,000. Well, a 1.5 point differential on interest rate, might be $7,000 or $8,000, right? And you have to apply that logic to it.
Maybe we can dive into what leaning into the market means a little more. Can you just explain a little bit more what you mean by leaning into the market and how people can do that more as we see this continuing over the next year and a half? So
when you're leaning into the market, we know that the inflation bubble has burst. Interest rates might go up at a Fed level maybe one or two more times. I don't know why they would, but it might. But it won't matter much at this point. We're really at the other end of that event. We had the ascension. Now we have the decline, and now we're in the decline phase. That leaning into the market really would be leaning into buying that new house now, or putting your house on the market now to get the other one, right? Whatever your move is, moving up or moving down or relocating, and not waiting for interest rates to go down, because as interest rates go down, prices are going to go up. And leaning into the market in this context really would be leaning into the market now before prices really start to go up. Because no matter what happens, Kevin, we are still chronically short in inventory, and that is not going to change anytime soon. Mm-hmm. So the fundamental aspect of this market is inventory, and we're critically short of it, and there will be no change in that for the foreseeable future. So as rates go down, things become more affordable, prices are going to go up. Getting ahead of that curve, even though you might be buying with a slightly higher interest rate, is leaning into the market. Because then you're going to be the one that as rates go down, you're going to be getting the benefit of the appreciation.
Couldn't agree more. I mean, I think we're seeing that there's opportunities for everyone to lean into the market, regardless of which environment you're in.
That's right.
So maybe we can discuss how people can make the most of their environment, regardless of what that environment is.
Yeah. And just to backtrack to your comment, is that this has gone from nuance to trend to fact. Now, this is just a fact. The fact is the people who can, where it makes sense, the smart play is to lean into the market now. Don't wait. Right? Mm-hmm. So one of my favorite quotes is about Cortez, after a long expedition, landed in Mexico, and his crews were exhausted, and he had them burn their ships because they couldn't go home. They had to make it work. And it's really kind of one of my favorite quotes. Because it is true. You have to make what you have work, because you only have what you have. And so if you have a set of circumstances, then in every set of circumstance, there's an opportunity. You might have to, dig forward a little bit. And I think in this case, the burn your ships analogy is don't worry about rates. This is the environment you got. If you want to go do something, do it. do it, and then you can adjust later. And so I think, I was thinking about it this morning, and I think that really applies to this environment. This is the environment you have. Figure out how to make it work, and you will benefit by it.
No, I think that's a fair point, a great point, right? I mean, people who wait don't necessarily have the opportunity to be able to participate in the game, right? Do you want to be on the sidelines or do you want to be in the game? And so by not waiting and by not holding out, but instead leaning into the market and making the best of your environment, as you thoughtfully crafted and spoke about, puts you in the best position to take advantages of whatever your goals are, right? Whether that's moving to a new home or downsizing or selling or investing. So I think that's great. For those that are looking to invest, how can they lean into the market right now?
Well, I think the same thing. Real estate, other than, we circulated last week a chart that I found from a call that I was on about the two asset classes that have always outpaced inflation as investments has been stocks 100% of the time, and real estate 91% of the time. So if you're investing in real estate, this is a perfect time to invest in real estate. It's perfect because the barriers to producing more real estate are really pretty high right now, producing more housing, right? And so I think that whether you're buying multifamilies or even single families, things like that, commercial property, this is a great time to be doing this. Again, your costs will be a little bit higher because of your borrowing costs will be higher because of rates, but your sales prices will be lower than there will be in the future. And from a what do you want to bet on perspective, well, real estate is number two out of all equity classes. Out of all investment classes that you'd want to bet on. So take a pick. Take your pick: stocks or real estate.
Couldn't have said it better. I think about that often, right? There's a lot of us who happen to be in a home now, whether it's their first home or second home, and have had the opportunity to invest in the past and took advantage of the great market during the pandemic. Right. I'm one of those people that are listening to these Change the Market episodes and going, why am I on the sidelines right now? Right? So I think that's a great point for buyers, sellers, or investors in general. And I think maybe that's a great way to wrap it up. If you want to kind of if you want to summarize the whole points of the last 4 episodes, and I'll let you wrap it up, but what I'm taking away from it is the burn your ships analogy, right?
Make it work.
Make it work. Thank you. Don't make interest rates your barometer.
Yeah. Don't you can't control it, so you can always buy the house. I read this article. I just read this article. Again, I kind of filter the news and then anecdotally what I see, right? And it said, and I think Carrie McDougall, the sales director in our North Conway office, had said this, and I had forgotten this term until she said it. It made me smile. It's like, well, you date your rate, but you marry the house. So the interest rate's temporary, but the house isn't. And that's such good advice.
Great advice. And I think that's a great way to end this week's episode with Chris Masiello. You date the rate, you marry the house, take advantage of the environment you have today. Thank you, Chris, for a great episode this week. Please like, share, comment, subscribe. I definitely want to see your comments about which host you prefer, whether it's Peyton or myself, Kevin Chemala, this week. I'm excited to share that feedback with every one of our listeners. And we'll see you again next week for another episode of Change the Market.
All right, folks. Good to be with you. Good to see you, Kevin. Thanks.